Hi everyone, welcome to my channel. I'm Doris and I'm here to share with you about my updates in my stock account. Today my stock account has made a total loss of $2,428 US. US stocks ended lower for the fifth straight day, but Biden and Yellen interface. Interbank financing pressure burst. The US sovereign credit risk hit a record high. In my account today, SQQQ and DRV both made a loss today. DRV made a total loss of 4.41% to 53.55, and SQQQ made a loss of 2.17% to $40.19. Right now, the total loss in my account is $20,038.57. The net asset of my accounts is $81,142.89. As for the market today, the banking industry is closed significantly lower of a negative 6.95%, and the other industries closed mixed. The oil and gas industry closed 2.66% lower. Dow Jones Industrial Average decreased for 0.28% to $31,819.14. Nasdaq Composite made a gain of 0.45% to 11,188.84, and S&P 500 made a loss of 0.15% to 3,855.76. U.S. stocks closed mixed on Monday, with the Dow Jones down for a fifth straight session. Investors are evaluating a plan to allow Silicon Valley Bank depositors to make withdrawals and provide additional funds to other banks. Some analysts expect the Fed to slow the pace of interest rate hike. The CBOE Volatility Index (VIX), a measure of market panic, climbed up on Monday to its highest level since 2022 after the collapse of Silicon Valley Bank. JP Morgan, Citibank, Wells Fargo, and other big banks under pressure. The regional banking sector fell sharply, with the First Republic Bank down more than 60%, while Western Pacific, United Bank, and the Western Union Bank also falling sharply. On Monday, the Treasury Department, the Federal Reserve, and the Federal Deposit Insurance Corporation (FDIC) issued a joint statement announcing action against the Silicon Valley Bank collapse. Starting on Monday, March 13th, depositors can withdraw all of their funds. Any losses related to bankruptcy of SVB will not be borne by the taxpayers. This joint statement said, "Today we are taking decisive action to protect the U.S. economy by strengthening public confidence in our banking system." The Fed also said it was creating a new bank term funding program, designed to protect deposits. The platform will provide up to 1-year loan to banks, saving associations, credit unions, and other institutions. U.S. President Joe Biden has said on Monday that he would ask the Congress to strengthen regulations on the banking system. Faced with collapse of the two banks, he sought to quell public concerns about the state of the U.S. economy. The explosion of Silicon Valley Bank and Signature Bank have raised fears of a full-blown crisis on the banking sector. Mr. Biden is trying to reassure the public about the state of the U.S. financial system. White House spokesman Jim Pierre said on Monday that the federal government's response to the Silicon Valley Bank incident was not a bailout and will not be the same as in 2008. The day earlier, Treasury Secretary Janet Yellen said Sunday that the core Silicon Valley Bank failure was the Fed's continued aggressive interest rate hike, rather than technical or corporate issues, and the government would not bail out the banks. In addition, New York State's Signature Bank was closed on Monday by state regulators. All of its depositors will be fully compensated, and taxpayers will not be bearing any loss. Bleakly, Pierre Cookvar, a chief investment officer of the financial group, said Sunday, "Over the weekend, there was only one either-or event. Either 100% of uninsured depositors are supported or not. This does not necessarily answer the question that arises from now on. What is the economic impact of banking being forced to raise deposit rates across the board? He said, looking ahead, I am more concerned about the profitability of the banks than their balance sheets. Fears that the Silicon Valley banking crisis could spread across the financial system have led investors to sharply lower bets on aggressive rate hikes by the Federal Reserve and even central banks around the world. Given the recent pressure on the banking system, Goldman Sachs does not think the Fed will raise interest rates at its March 22nd meeting. Goldman Sachs holds its forecast that the Fed will raise rates by 25 basis points in May, June, and July, and now expects end rates at 5.25% to 5.5%. J.S. Morgan chief economist Michael Feroli said on Sunday that it continued to expect a 25 basis point rate hike next week's meeting. Even before the banking sector had problems, the Feroli thought a 50 basis point rate hike was a bad move and still thinks so. Leading investor Larry McDonald said the collapse of Silicon Valley banks could prompt the Fed to cut interest rates by 100 basis points by December to prevent crisis from spreading the financial system. That would mark a sharp reversal in Fed's current aggressive policy, tightening path to curb inflation. McDonald notes that the Fed's total of 450 basis points over the past year has made returns on short-term treasury bonds more attractive, helping depositors to reduce their deposits at banks such as SVB. Essentially, it was the previous big rate hike that caused the bank to run. According to CCMM's Fed Watch tool, CME, the probability of a 50 basis point increase to 4.75% to 5% is 96%. The probability of a 50 basis point increase down to 0, and the probability of keeping the current rate unchanged at 4%. In addition, market expectations for peak ECB rates fell below 3.5%. Traders expect the Fed to raise interest rates by less than 14 basis points next week. Jeffrey Gundlach, Chief Investment Officer of the new debt King, said on Monday that treasuries have sharply steepened after a sustained inversion, strongly suggesting a looming U.S. recession. Gundlach said, the Fed has the same debt and maturity mismatch as Silicon Valley banks, so the only way the Fed can support the system is one, print money. Investors are now looking for a number of economic reports this week. Tuesday's Consumer Price Index report was the last major inflation data ahead of the Fed's next meeting, ending on March 22nd. This also includes the February retail sales report and the Producer Price Index. Amit Sinha, head of the multiple assets design of Voya Investment Management, said, in the coming week, the market will focus closely watching how fear and the economic fundamentals work. If the market sees the Silicon Valley Bank bankruptcy as an isolated event, both fear and selling could weaken. If that happens, then the focus is back to the Fed and inflation. The U.S. sovereign credit risk hit a record high. Both Biden and Yellen say the banking system is resilient, but all three indicators are going red. Among them, the U.S. sovereign credit risk based on the one-year CDs, also known as the dollar depreciation risk, exceeded the level when the U.S. sovereign credit rating was downgraded by S&P 500 in 2011. When U.S. President Joe Biden and Treasury Secretary Janet Yellen said, country's banking system is resilient, all three indicators are red. One of them is the FRA-OIS spread. It rose to the highest level pre-Lehman Brothers crisis level except during the COVID-19 pandemic, underscoring the sharp rise in the credit risk for systemic banks. Wall Street has noted that FRA-OIS is one of the most important indicators of the financing constraints in the interbank market and money market risk, and an important pressure indicator that the Fed are also closely monitoring for each rise. It is seen as a market measure for how expensive or how cheap banks will borrow over risk-free rates, such as treasury rates. The last time FRA-OIS rose to such high was in the beginning of the outbreak in March 2020, when the Fed launched a $1 trillion stimulus program to rescue the market, buying corporate bonds and resuming trillions of dollars of QE. Mr. Lynn Graham Taylor, a senior interest rate strategist at ABN Rabobank, commented that it was unrealistic for banks to lack more discerning judgment about their lenders. In the US, there are relative limitations, of course. The banking system comes under pressure as people look at each other's business models to see if anyone is in trouble. Another indicator, the average cross-currency basis swap, measures of global dollar liquidity, which has narrowed sharply over the past 2 sessions as companies are hoarding dollars. This shows that the world is seeking cash, and the willingness to pay cash is reflected on its balance sheet. The last indicator is U.S. sovereign credit risk based on 1-year U.S. credit default swap, FCDS spread, also called the depreciation risk of the dollar. It has reached a record high, surpassing when the U.S. sovereign credit rating was downgraded by S&P 500 in S&P in 2011 as a peak of federal government shutdown in 2013. We are seeing that this move is more likely suggesting pressure than anything else, commented Pia Christensen, chief analyst at Danish bank Danske Bank. Financial blog Zero Hedge warned Biden and Yellen that the banking system was not fine, but that it was in trouble. That may be why the so-called alternative cryptocurrency surged on Monday. Bitcoin hit $24,000 in early trading Monday, trading 24,600 for the first time since late February, up nearly 3,800 or about 18% from the intraday low in Asian trading. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.